Good afternoon, ladies and gentlemen. Welcome to the Victoria PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and I'm sure the company will be most grateful for your participation. And I'd now like to hand over to Executive Chairman, Jeff Wilding. Good afternoon.
Good afternoon, everybody. I'd just like to introduce you to Philip Hammers, who's sitting on my left, as the CEO, and Brian Morgan, who is the CFO, who's joined us in late August. So we'll begin by just a quick overview from me. I'll then hand over to Brian, who will take you through some of the financials for the half year, and then Philip will give you some operational highlights. As everybody will no doubt know by now, revenues for the half year was 776 million, EBITDA was just over 100 million, and the pre-tax profit was 53 million. The business needed to cope with very high inflation in the first half, and we've done that firstly through thoughtful price increases. Where we've needed to, we have increased prices to protect our cash margin. And by our cash margin, I mean the amount of profit contribution from the product. So that is how we've managed to maintain our earnings or grow our earnings to 100 million for the half year. We've also done some product re-engineering. We do this in cooperation with our customers, so to hit certain price points. And Philip will talk you through that a little later. We've had a certain amount of hedging and contracted pricing into our input costs that has helped mitigate some of the very high inflation we've seen, particularly in energy. And lastly, and again, Philip I won't steal his thunder, he'll talk about the service offering that we provide to our customers, which makes them very loyal to Victoria. Going forward, and I'm looking forward to the next 12 or 18 months, we expect to see the operating margin of the business improve considerably from where it sits today. So the EBITDA margin for the half year was 13%. We are comfortable that we can see that getting back into the mid to high teens over the next 12 to 18 months, and there's a number of factors that will contribute to it. Firstly is the synergy gains from the various integration projects that Philip is running for primarily in Balta, but we've also got projects running in Italy and in Turkey. There's also some gains to be made with our businesses in the US. So again, I'll leave Philip to talk you through that, but those synergy gains will add to our margins. The second area where we're expecting to see gains in our margin is a reduction in our cost of goods sold. Now, this is the input costs into the business, primarily raw materials. And you can see from those two charts, the left-hand chart, which is Commodus, is a proxy for the price of polypropylene fiber, which makes up nearly 50% of our cost of goods sold for the soft flooring products, which is carpet and rugs. And you can see that we were paying around 1,400 sterling per tonne earlier this year. The period at the top there covers basically from April through to June. Now the price has been steadily trending downwards since then. But of course, the product that we are currently selling today was manufactured using raw materials that was purchased for around 1,400 sterling a tonne. Once that product has been sold through, which it will be in the next month or two, and the next turn of inventory comes through, the product that we are currently manufacturing has been made with raw materials costing us between 800 and 1,000 pounds sterling per tonne. And so because our cost of goods sold will come down dramatically, needless to say, the operating margin will go up. Now, some of that we will give back to our customers in terms of price reductions, but some of that we will also keep. And the consequence of that, as I say, is we expect our operating margins over the next 12 months or so to be back up into the high teens where they have been historically over the last few years. The chart on the right-hand side covers the costs of shipping containers, which are also important, particularly for our US business, which imports a lot of the product that it sells from the Far East, primarily Vietnam, but also China and Taiwan. So the cost of those shipping containers have fallen dramatically, and again, that will feed through into our cost of goods sold that you'll see in the next calendar year. Demand is highly variable across the different markets that we operate in. We are seeing soft demand in the UK, but that's being made up by stronger demand in the US, parts of Europe, and the Middle East, where we also export, and this is the value of being a highly geographically diversified company. And as a result, if we were to look across the business as a whole, we are seeing relatively solid demand for product, and again, that's reflected in the fact that our like-for-like revenues grew in H1 by 7.7%, although the overall growth was 59% because of acquisitions. Secondly, another point that's worth mentioning is Victoria is one of the most cost-efficient manufacturers of flooring in Europe, and we've got very modern, well-invested factories. And the fact that we do have industry-leading margins gives us the capacity to absorb both costs of increases in raw materials and also declines in demand, should it happen. But whereas some of our competitors will really struggle. And we have seen, for example, in the last few months, quite a number of our competitors in the ceramics industry have shut down their production. Now, the market might be slightly softer, but because 30% of our competitors have stopped production, our market share has grown, and that's what's maintained our revenues and our operating margins in the ceramic space. The other, on the right-hand side, we've just talked about the fact that Victoria has low operational gearing. The reason this is important is that our cost base fluctuates with our revenue. So if there was a period of softer demand across all our products and across all our markets, if that did happen, about half our cost base is fully variable. It's essentially raw materials. Another 30% is semi-variable, which we define as something that we can vary with management action within 90 days, and only 8% of our cost base is truly fixed. So just talking about our balance sheet very quickly, we have a lot of liquidity. We've got over 250 million of cash and undrawn credit lines. Our debt facilities consist of long-dated fixed rate covenant-like bonds. Our interest rate at the present time that we're paying through until 2026 in one instance and 2028 in the other is 3.6%. So we have, and that's a fixed rate. On the right-hand side, we refer to our cash flow in H2. We expect over 100 million of net positive cash coming into the company in the current half year. That's going to come from a number of areas. Firstly, the normalization of the inventory levels. So last year and earlier this year, when there was quite severe disruption to supply chains, Philip very wisely bought a substantial amount of raw materials so that we were able to keep our factories operating at full capacity. And that's one of the reasons that our organic growth was so strong last year. But that did mean that we invested a lot of money into raw materials. Now that that's normalizing, we are reducing our purchases of raw materials back to normal levels, and we will run down the higher levels of raw materials that we've been carrying for the last 15 months. The second area of inventory normalization relates to ceramic tiles, where earlier this year in July and August particularly, there were very severe concerns about gas rationing and very high extreme gas prices over winter. So what, again, the management team did was build up levels of ceramic tiles so that we could maintain our supply to customers at normal levels for 3 months, even if we had to completely suspend production because there was no energy through gas rationing, or because the prices got so high it was uneconomic to produce. So clearly the concerns around that have now diminished significantly, and so we will start, in fact we're doing it now, we're reducing the finished goods as well. So that will generate a substantial portion of the 100 million in the current half year as we go back to normal levels. Of course, there's also operating profits in H2. We confirmed yesterday that we expect to make another 100 million of EBITDA in H2. So that will contribute to cash flow. And lastly, with some of the rationalisation and integration projects that Philip has underway on the operational side of the business, we will be left with surplus assets that are no longer required, which we can sell, and that will also contribute to the cash flow. So what I'll do now is just hand you over to Brian to run through some of the details of the actual financial statements that were issued yesterday.
Thanks, Jeff. Good morning, good afternoon, everyone. Let me just quickly run through the group financial slides, and then Philip will take you through the detail on the divisions. So this has been another record period for Victoria, and we expect that to continue into the second half. As you can see from this slide, we delivered revenue of 771 million. That's the underlying revenue, which is an increase of 58%. For the underlying growth, it was 7.7% for the group. The like-for-like growth is shown before the impact of acquisitions and also on a constant currency basis. The majority of divisions, and again, Philip will come back and talk about this, show double-digit growth, even when compared to the same period last year, which was a record for us coming out of COVID. In terms of EBITDA, we achieved over 100 million, a 19% increase on the same period last year, driven by a mixture of organic growth and the acquisitions we made in the period. We completed 2 acquisitions, the largest being the carve-out of the Rugs and Broadloom business of Balta, which is based in Belgium and also has 2 factories in Turkey. We completed this in April, and then in June, we also completed the acquisition of a further small rugs manufacturer, Rugol, in Belgium. These acquisitions made us the largest soft flooring manufacturer in Europe. So if we move on to the next slide, please. This bridge shows the group underlying EBITDA margin, and we're comparing where we ended up at the end of H1 with the full year of 2022. And as you can see, we finished last year with a group underlying margin of 16%. There have been 2 major impacts on our margins, which were pretty similar to last year in terms of the type of impacts: the acquisition mix effect and also the cost inflation pass-through. The acquisition mix effect comes about as we tend to buy businesses with lower margins than our own, and during the integration period, we expect to see a drag on the overall group margin as we complete our synergy projects. This can be seen this year with 110 basis points reduction in reported margin. The most significant impact is on our UK and Europe soft flooring division as we continue to integrate the Balta acquisition. This business will be fully integrated into our overall operations in the coming 24 months and will provide us with significant opportunities in the UK and US markets. The second impact, which again we highlighted when we announced our full year results in July, is driven by the sometimes double-digit inflation on our input costs and how we pass these on to customers. As Jeff said, we continue to see inflationary pressures in raw materials, labour and energy across all of our businesses in H1. To mitigate this, the management teams have implemented price increases where necessary, been laser focused on cost and synergy initiatives, hedged or managed key input costs where available, and worked on product engineering with our customers to mutual benefit. To support our customers when we increase prices, we passed on the cost without adding additional margin to the cost inflation. This has helped to maintain absolute margin and market share, but has a negative impact, 130 basis points on the margin as reported. This leaves us with a reported margin for the first 6 months of this year of 13%, and we expect this to improve in the second half as we've already seen raw material prices stabilise, synergy projects will continue to deliver, and we'll see the benefit of cost savings. Moving on to slide 12. This slide documents our exceptional and non-underlying items, and I'll spend a little bit of time here just talking through some of the major ones. These items are either irregular, and therefore including them in the assessment of the business performance would lead to a distortion of trends, or there are technical adjustments which ensure that the group's financial statements are in compliance with IFRS, but do not reflect the underlying operating performance of the business, or they're both of those. There are only two items here which are cash items and total 6.2 million, and the rest are non-cash. The two cash items are the acquisition and disposal related costs. This is fees that we pay to advisors in relation to completed and aborted acquisitions in the period. And this was predominantly the completion of Balsa, the acquisition of Rego, and also a recently completed acquisition of IWT. And the cost is down year on year as a result of lower volume of acquisitions this year. The other cash cost is the reorganization costs as we integrate our acquisitions into the business. And the majority of this relates to Balsa. It should be noted that there will be more costs in H2 related to Balsa as we go through the reorganization, but we expect these costs to be cash neutral over time with the disposal of surplus real estate assets once the reorganization is complete. One or two other items to point, go back to Jeff, sorry, thank you. One or two other items to point out here. The amortization of acquired intangibles is a large number coming through here, which relates to the amortization of the fair value of certain intangibles that we get when we acquire businesses. And we put this in here to avoid any double counting, as we also incur costs to maintain those customer relationships or brands across our business. And finally, on this slide, we have also been required to adopt hyperinflationary accounting in our Turkish businesses under IFRS, as the rate of inflation on a cumulative basis over the last 3 years has been in excess of 100%. This means that we have to re-index the balance sheets of those businesses and also the income statements of those businesses. And this year, that's resulted in a 1.5 million gain at EBITDA level and a 1.4 million monetary gain in finance costs. Given these businesses that we have in Turkey, one of which is a ceramics business and the other is part of Balsa, the predominant amounts of their revenue is in euros and US dollars. We don't believe that adopting the hyperinflationary accounting reflects the true underlying performance of the business, and therefore we back those out. If we move on to cash, you'll see that as a business we generated 22.1 million of operating cash flow before interest, tax and exceptional items for the period. And a key driver on the reduction of this has been the investment that we've made in working capital in the first half. There are a number of drivers up for this. One is the fact that, as Jeff mentioned, we've invested in raw materials and also finished goods to maintain the service levels to our customers. And we're now seeing supply chains return to normal levels, and also the lack of requirement to hold inventory in the ceramics division, as we don't see any capital gas rationing requirements in that market. So in the second half, we will start to work that through to produce cash. The other component that's impacted working capital is in relation to the purchases that we made in the first half, which are gone through raw materials and into finished goods, and they're now working their way through our receivables balances. Again, we will expect to see this unwind in the second half as the input costs have been reducing back to historical levels, and also management are taking actions overall in the inventory. On the next slide, you'll see a graphical representation of our movement in net debt in the period. We ended the period with the net debt of 651.5 million. And the reason for the increase on this was to do with the acquisitions that we made in the period. So the largest block on this graph is the 154 million, and this represents the purchase of Balsa and also Rego in the period. The other item worth noting on this is the 27.5 million, which is to do increase in our net debt. That's a translation impact as a result of weaker sterling. And finally, for me on the last slide, the previous slide you saw the net debt. We have not increased our gross debt in the period. We have got our senior secured debt, our long tenured and low coupon bonds. Those are still the same as they were at the year end, other than a translation impact because they are euro denominated. Cash, the reduction in cash has been for the purchase of the Balsa and Rego, and we also picked up a small amount of finance leases in the acquisition of Balsa. This has left us with 3.4 times leverage, which is in line with our overall group financial policy. And also on the slide, you can see that we've 73.5 million worth of cash, and that along with 150 million worth of undrawn RCF plus other smaller facilities that we have around the group, leaves us in a very comfortable position of having 250 million worth of liquidity as we ended the period. So with that, I'll hand you over to Philip.
Thank you, Brian. Just on the operational overview, for the record, we report on 4 divisions. We have UK and Europe soft flooring. We have the UK and Europe ceramics division. We have then separately Australia, and the 4th division is the US. So the focus is entirely on operations and acquisition integration. We are convinced that we can have significant synergies, which will drive material earnings and cash flow growth over the next couple of years. So the 2 things, if we look at the first division, UK and Europe soft flooring, as we see on the slide here, the 2 projects I would like to talk to you about is Balta, and I can see already a few questions popping up with regards to Balta and the status of the acquisition. And secondly, logistics. I want to talk you through some of the logistic projects which we're having in the UK. Well, first of all, if we talk about Balta, just a reminder, when we did the acquisition of Balta, about 350 million of revenue which we acquired. 2/3 of that was rugs, 1/3 was broadloom. Broadloom about 100 million euros. 70% of that sold into the UK, 30% on the continent. So let's focus on rugs for a moment. So we want to redesign the footprint for rugs. So we want to do less in Belgium and focus more on the Turkish operation. Just for the record, Balta has 3 plants in Belgium, and rugs has 2 plants in Turkey and 2 distribution centers in the US. So in redesigning the footprint, we want to do less in Belgium and more in Turkey. So we have decided to close 1 plant, the Avelhem plant. We are in the process of negotiation with the trade unions, so we should be finishing these negotiations, and we will be laying off 240 people. 260 people, and 140 people will be transferring to other plants in Belgium. So the Turkish operation will be expanded, and most of the yarn manufacturing, which was now happening in Belgium, will be done in Turkey, as most of the components of the goods sold are cheaper in Turkey. With regards to the broadloom section, this is 1/3 of the business. So it is our intention to make it slightly smaller in Belgium and push some of the quantities which we are making in the Belgian plant into the UK plant. We think about 4 or 5 million square meters, which will be pushed into the UK plants. We still have a bit of capacity in the UK plants. We have 2 manufacturing plants in the UK. So we are trying to bring Balta broadloom closer to the market. As an end result, we will be having, for the UK market, we will be having 3 plants, 3 manufacturing plants, of which 1 in Belgium and 2 in the UK. We are having 4 distribution centers in the UK, and we are running 7 brands. Balta, the acquisition of Balta, is giving us the 7th brand. And on top of that, in terms of the Balta integration, there was also a corporate office in Balta. We're also looking to trim that down to fit the current size of Balta. Some about logistics. I've been talking briefly about logistics. I want to remind everyone that logistics is a key differentiating factor for Victoria. So we're not only a manufacturer, we're also a distributor in the UK market. This is important to remember. And we have just commissioned a purpose-built warehouse in Worcester, 190,000 square feet warehouse, which is going to be net zero carbon, and we will take access of that in February next year. We've just started to take early access to start mounting the cutting tables. So all of that is in the process of happening. The service proposition, for the record, remains over 90%, and the service proposition of next day delivery remains over 90%. A reminder as well, with Victoria, we're in the medium to high end of the market. We're by no means in the volume end of the market, so which giving us a bit of price protection as well, because of the service we are able to give to our retailers. Second reported division is ceramics. So we have three geographies where we have ceramics plants. That's Italy, Spain, and Turkey. So Italy, we have 3 plants in Italy, where we've done significant investments, which have come to an end in the back end of last year. We're taking the full benefit of that in the first half of this year. As you may have seen, we've had record results and profit in the ceramics business. We've had a pent-up demand, especially from the DIY. DIY business has been very strong in the continent, in Europe and in the US. On the back of some of the investments we've done in the back end of last year in Italy. So we have had extra kilns which have given us the opportunity to have more output and to make specific sizes, larger sizes mainly, because we can see a demand in larger sizes in the current market environment. In terms of Spain, the main focus in Spain has been the repositioning of the Saloni brand. Saloni brand is in fact a commercial brand which we are having. It's the only commercial brand we are having, because most of the other brands, not only in ceramics but also in soft flooring or residential, 85% of what we're doing is residential, about 15% is in the commercial area. We've also introduced a new showroom in Alicante, and mid of December we will be opening a new showroom in Madrid for Saloni. The last geography in ceramics is Turkey. Turkey, we've done an acquisition last year, which was Graniser. Graniser was exporting 70% to Europe and to the US, 30% was domestic sales. We are currently running a CapEx program in Graniser, which will allow us to increase the 70% export to 90, even up to 100%, because we are less interested in the local domestic market. We are more interested in the export. And this is why, in order to meet quality standards, we have had to run CapExes for quality purposes in terms of the inkjet printers and the packaging of the finishing lines. That's the second geography, so we can move on to the third geography, which is Australia. Australia, we've seen strong organic revenue and EBITDA growth. As you may remember, Australia came out later than out of the pandemic, and we've seen a very good solid demand in the first half year. Another how would I say, conclusion or effect which we've seen in the Australian market is that we have had a lesser supply chain disruption, which has and also less inflationary pressure from the raw material components and the energy components. So all components of the cost of goods sold have been less. So we have had to perform lesser price increases in Australia than we had to do in Europe and the US. A popular product group which we are having in Australia is LVT. We have a distribution facility in Australia under the brand Dunlop, and this is growing very fast in the Australian market. Underlay sales are on track. We are at full capacity in underlay in our Sydney plant. It's been sold, it's optimized in terms of quantities and price. Last but not least is the American market. Currently, it has been the strategy of the Victoria Group to acquire distribution outlets in the US rather than manufacturing facilities. And in the distribution, we have the revenue currently across the group in the US is $400 million. This is split over Cali, which is an omni-channel distributor, which we bought last year. And then 45% of the Balta revenue in rugs, so almost $100 million, is also US business. We've done a recent acquisition of a distributor in Florida, in Palm City, who's working essentially in the east of the US, but having ambitions to become a national distributor in the US. So if we take all this distribution capacity, this means that we currently have, including the Balta warehouses, we have 4 warehouses on the East Coast, and we are trying to integrate as much and looking for synergies and cross-selling opportunities to sell as much product which we are making in the group. So this includes outdoor rugs. There's a good demand of outdoor rugs in the US market, and also artificial turf. Just want to remind you that we have a large artificial turf factory in the Netherlands, and we are exporting more and more into the US, and we will be using these distribution facilities to support this growth. I think this is it, Jeff. I would like to hand over the presentation back to you.
Mark, that's us completed on the presentation. We're quite happy now to move to Q&A.
That's great. Thank you very much indeed for your update. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted already, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, will be available via your Investor Meet company dashboard. As you can see, Jeff, you've had a number of questions submitted by investors, so thank you to everybody on today's call for your engagement. If I may, Jeff, if I could just hand back to you to read out those questions and pose them to the team and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Thank you. So, look, rather than read the question verbatim, there's a number of questions that I can see on different key topics, and so I'll paraphrase to make this simple, because we can answer a number of questions at the same time. We've got some questions around short interest in the company and the buyback of our own shares. So, look, I'm not privy to the investment case clearly of the various firms that have taken a short position in Victoria. I think they clearly have a view on the outlook of the business, which the directors disagree with, for the very fact that we think the shares represent good value at current levels, and we are busy buying back our shares. We are not buying back our shares in any attempt to try and squeeze out the shorts. We're simply buying back our shares because they represent a very good use of our capital at these current share prices. And you'll have also seen a number of our shareholders, of our directors, have also bought shares in the last few months. So there's just a difference of viewpoint on value and the outlook for the business, and I'm sure in time that will be resolved one way or another. We've got a question on energy prices and hedging. So we take the view on that our hedging is commercially sensitive, so we don't disclose it. However, I think it's fair to say that the fact that the company has confirmed that it is going to hit the market consensus numbers, which are about 200 million of EBITDA for the full year, and we've also expressed a view as to our confidence in the next financial year. I think you can take some comfort that we feel pretty comfortable with the position on our energy input costs. The Kidderminster warehouse is not one of the properties that is to be sold, and that will be retained as a warehouse because of the growth of the business. But the new warehouse is actually located in Worcester, which is just off the motorway in the Midlands, and it's a very smart carbon neutral site. These questions are sort of like in no particular order, they're random. The preferred equity, we do not expect it to be converted into common equity. So the preferred equity is an interesting instrument. The company can call it at any time in 25 million sterling blocks. So we can buy the preferred equity back at 25 million sterling at a time. There's 225 million outstanding at the present time. So and it can be converted after 6 years at the preferred equity holder, which is Coke Industries. At their option, they can convert that into ordinary equity at the then share price. So the share price at the time. However, as we have highlighted in the statement to the shareholders yesterday, and also while we were speaking with you today, it's our expectation that the company will pile up cash over the next 18 months. Acquisitions are taking a back step compared to the focus on integration of the existing businesses, because there are tens of millions of synergy opportunities to be realized in the existing business. So we expect to pile up cash, and then that gives us optionality in 6, 12, 18 months, whether we use that cash to pay down the debt, whether we use it to buy back the preference shares. But in any event, there is no intention for the preference shares to be converted into ordinary shares. Sorry, I just need to scroll up because the questions are coming in faster than we can read them out. Right, actually there was one, scroll down. Yeah, sorry, I need to scroll down the other way. Okay, there's a question about the backing on broadloom carpet, which can you read that?
Well, there used to be a different, indeed, there used to be a different kind of backing in the original Kidderminster plant. We never sold that backing line, for the record, but the most commonly used is latex for the moment. But we are working on new types of backing, which we are currently already using on rugs, special backing which do not hold latex and which are 100% recyclable. Then there was another question on preferred equity, but I think you've dealt with that, Jeff.
Yeah.
So we cannot see any other questions for now.
That's great. Thank you very much indeed. And of course, if any further questions do come in, then we'll make those available to you post today's call. Jeff, and to the rest of the team, I know investor feedback is particularly important to you and to the company, and I'll shortly redirect those on the call to give you their feedback. But I wondered if I may, Jeff, just come back to you just to close off with a few closing comments, and then I'll redirect investors to give their feedback.
Sure. So the key messages the key two messages that we would like investors to take away from the conversation today is, firstly, the focus is of the company over the next 12 or 18 months. The focus is on operational integration and realizing the synergy. As I said a few minutes ago, there are tens of millions of synergy gains. Even the closure of the Albion site that Philip was talking about earlier, that will happen next month, and the saving on that alone is $1 million a month in labour charges. So there are some very significant synergy projects we expect to realise over the next 12 or 18 months, and that's where we think the best application of management time is. And then the second area that we want people to hear is that we expect to generate 100 million of cash in H2, and we think we can continue with that rate of cash generation into the following financial year. And it is the group's or the board's view that the company will achieve its 200 million EBITDA for which I believe is the market consensus number for the full year, or it's thereabouts. We are confident that we will achieve 200 million of EBITDA for the full year. So those are the key messages we want you to take away from this conversation today.
That's great, Jeff. Thank you very much indeed, and to the team from Victoria. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Victoria PLC, we'd like to thank you for attending today's presentation. Good afternoon to you all.